Hello and welcome to yet another episode of Back to School. It's an annual event that ET NOW does every year around Diwali, where we take three marquee investment advisors, if I can put it that way, take them back to school, get them interacting with the students and you viewers, and ask them, kind of nibble in their minds about their approach to investment in the current market scenario and otherwise. Three very eminent market experts with us on the panel today. Need no introduction. Pradip, Shah, Nilesh, Shah, Ratnesh Kumar, all join us in our studios, or rather at JBIMS. We are live from Jamnalal Bajaj Institute of Management Studies. Thanks so much, all of you, for joining in. It's a simple question. Most people right now, when we talk to people, when the queries that come in about what to do in the market, everybody is asking about how to invest, because it seems to be a great next 5 years, next 10 years with a stable government, so on and so forth. How would you approach investments right now in the current market scenario and even otherwise?
Let me first say how pleased I am to be at Jamnalal Bajaj Institute of Management Studies.
You've taught here?
Years ago, when
Okay.
I came back from Harvard, I taught in the Master of Management Studies program for a couple of years. And something I noticed this time is that there are very few women in the class. I think there used to be many more when I was teaching. Maybe it was because of me. Anyway, so I was very pleased. But I'm very pleased to be here, and it's always refreshing to get ideas from young people. Their thinking is different. It's very new age, and it's makes one think more. Coming to the question that you asked, you don't invest in the market. At least I don't. There are some times when you can buy an index and forget about it when you see a wave of optimism, as for instance, let's say before this election, when if you took a point of view that a BJP government would come into power, change from the past, you could buy an index and you would ride the curve very well. But otherwise you invest individually in stocks. And currently the global environment is favorable for investing in India, and the domestic macroeconomic environment is favorable for investing in India. But within that, you have to individually pick stocks. Okay,
and we'll come to how do people do that. But Nilesh, your initial assessment, you run a fund, it's done very well. How have you managed to do that? How would you approach investing in the current market scenario?
Well, I think, I think everybody needs to have his own style of investing. Yes, you need to be very cognizant about how the current scenario is. But I'll just share a very important data point, and I think it's very useful, that in the last 10 years, because we all say investing is about the long term, and in the last 10 years, probably, and it was the year 2004 when we had a change of government, and as a shock to that government, I probably think the Sensex had fallen to 4,000 or 5,000 on the lower side. And from 5,000, we are still today at 25,000 plus. So in the last 10 years, the Sensex has gone up about 5 times, okay, which is, I think, remarkable, which probably in terms of annualized returns, this would be in excess of 12%, which is tax-free returns. And in 10 years, look at all the negative things which have happened. We've had deficient monsoons, we've had droughts, we've had change of governments, we've had a government which has not done enough, we've had a commodity cycle boom. Oil has gone to $120 from maybe $20, $25 about 10, 12 years back. And despite all of this, we're still seeing a market which is up about 5 times in the last 10 years. Earnings are also up proportionately. In 10 years, if you really look at it, there has not been any significant re-rating of India in the last 10 years. So I think is that while on one hand you need to definitely have one eye in terms of what's really happening globally, what's happening locally, domestic factors, global factors. But I think at the end of it, you are investing into corporate India. It is corporate India which is really creating wealth. India is fortunate to have a very large number of entrepreneurs who keep trying, who are successful, who fail, retry. But finally, at the end of it, they really create wealth. So I think that India continues to be a good opportunity. The current environment is very favorable, and I see no reason why it's going to be any different over the next 10, 20 years also. So I think the wealth creation journey is going to last for the next several decades.
Okay, so the setup is positive. Both of them agree that you need to look at stocks as well. Ratnesh, let me bring you in this discussion as well. You advise a whole host of funds internationally, probably even locally, as to what should they be doing in a scenario like this. What would your advice be at this point of time?
So the approach that I advocate is always a portfolio approach, which is that first and foremost, one has to have a very thorough analysis of the macro, both in India and globally, and understand what are the themes and trends which are going to be working over the long term, whether it's 3 years or 5 years. And with that figured out, then we try and advise for stock selection within those themes. And so at the end of it, one gets a basket of stocks which are supposed to benefit or run on particular themes which are likely to be more successful than the average economy or the average market. And within the stock selection, one of the major factors which I would look at is ultimately you are investing in the company's stock and company strategy and success over the longer duration. In the short term, there may be some cyclical factors which might boost a company or which might depress a company. But how the company deals with multiple challenges over the period of cycles up and down, it is the management and the governance. So that becomes also a very important factor in stock selection, in portfolio construction.
Okay, interesting. So let me try and nail it down. Pradip, multiple ratios out there. People get confused. If you Google, you will hear why a ratio is not so great, or conversely, why a ratio is looking good as well. I mean, people grapple with PE, ROC, ROE, so on and so forth. And then I hear a lot of fund managers saying that, while I look at all of that, I definitely look at the quality of the management. That is probably number one, and then the other things come into play. How do you, segregate, and what is the most important according to you?
No, so I think Ratnesh pointed out, and I think everyone will endorse this, that you look at management as first and foremost and the last basis for investment. That is competence and integrity. Fortunately, in India, we have transparently dishonest managements at times. So you can easily rule out some of those companies. But within the competent, within the honest, then you have to make judgments on competence. And what do you look for in competence? That tenacity and drive and determination to overcome problems as they arise. Their ability to think through and solve problems, to make strategic decisions and tactical decisions that put their company in the forefront. So that's the judgment call. Typically, it's based on past track record of that company itself or some other companies, and you make judgments on that basis, sometimes on the basis of the individual personality and so on, especially where it is very individual dependent, as for instance, sometimes in the pharma research and so on, or other industries. So you make judgment call on the competence, integrity, and then the business, the industry characteristics, the key success factors for the industry, and how the company relates to those key success factors and so on. And from the analysis of the business and the industry and the company, follow the numbers. The numbers come out of the business. It's not the numbers that decide the business. So you look at the business to decide what the numbers are and what they will be going forward. And in the numbers, return on capital employed, to my mind, one of the most important ratios that you would look at. And consistently, how is it progressing? Is it steady? And that return on capital employed has to be above the interest rates that are obtaining in the market. Otherwise, the company is not earning enough money for themselves. So you have very large companies in India which are trading at 8 and 9% return on capital employed today. Some of the largest names, and it shocks you that they still get recommended, because on an earnings basis, a price earnings basis, they look lower than others. So return on capital employed, price earnings, and especially price earnings in relation to the peer group, and then price earnings to growth. What has been the growth in the earnings per share for the last few years, and whether it will continue. So that part is additionally, and then the profitability and debt equity.
Pradip, much like a sensuous piece of clothing, numbers hide more than they reveal. And we've seen that umpteen instances. I mean, results have been great, numbers look fairly okay, and then suddenly some news comes in and the stock goes down, investors are hurt. How critical would it be to correctly read what is it that is coming out? Because again, an average investor would probably have access to annual reports, maybe a few research reports, but not all. How does he decipher?
So we must differentiate between event-based changes in value of companies. So for instance, a regulatory action on a company which may or may not be warranted. Sometimes, for instance, in the case of Indraprastha Gas Limited, or NTPC, the regulator came and said the tariffs should not be this, they should be this. So they were lower, and therefore the stocks tanked because the regulator decided that. And they've challenged them in the courts of law, and again an event-based outcome will come. If the court says no, the regulator was wrong, the share stock price should again reflect a little better value. But there are some which are not event-based, and there, if it's just numbers, sometimes you have cooked up numbers. And you have seen after Satyam. Satyam was a classic example. I'm sure you studied it in your classes. But after Satyam, from the same city, there are companies like Deccan Chronicle, Jupiter Biosciences, Tanla Solutions, Northbridge Technologies, which make you wonder, did they have numbers which were reliable? Were the auditors doing the right job? Why is there no regulatory action? Now, these are questions one ought to ask and look at the history. I mean, you as students, you ought to look at them as to why they were at one time, Tanla was 700 rupees and then it's fallen to 18 rupees. Was there something with the numbers? So relying on auditors, relying on the management, at the end of the day, judgment on the management is very critical. Tatas, you know that they have been around for 150 years, Mahindras, they've been around and they don't believe in cooking up numbers.
Right.
But there may be others who may be because they want to access capital markets.
Sure.
And so they may have higher profits, maybe not sustainable, maybe even engineered.
Right.
And then if you go only on that basis of numbers, you do get caught sometimes.
I hope there are not too many Hyderabadis out here. You pretty much brought out 4 or 5 Hyderabad companies and gave that example.
To give you an example that after, in the same city, you had disasters for investors.
Yeah, of course. Okay, Ratnesh, let me take that point forward then. Nilesh brought out the point. I think the consensus out here is that the management quality is extremely, extremely important. Now, India has a whole host of new age entrepreneurs who are coming out. I'm guessing we'll find a few over 10 years from this batch as well. They don't have the track record, but some of these companies have immense promise, as some of the research reports of yours have indicated over the last 4 or 5 years as well. Those stocks have grown multifold. So since there is no history, how do you decide which one is great, which one is not?
Yeah, so and in many cases where there is history also, sometimes the future may not be following the same pattern as the history. I think bottom line is whether a management has track record or not. Ultimately, I would still look at the same factors, whether the management has a clear strategy, short term, long term, whether the management has adequate awareness of not just the opportunity but the risk. I think where a lot of the emerging market companies go wrong is there is a lot of awareness and excitement about following a particular opportunity. But the risks which lie along the way, there is far lesser investment on that, whether it's a regulatory risk, whether it is any other kind of political risk or geopolitical risk or any of those factors. I think what I would expect a good management to do, whether it's a new age management or management which has been there for 100, 150 years, is that whether they have clarity of thought and vision in all of that, and whether they have structures, organizational structure to support growth. I think one of the key things which I would look at in an absolutely new age sort of a company or industry is those are obviously entrepreneurs who have come up, they have a great idea, whether that idea can be matched with the organizational structure which can support a growth.
Okay, 2 quick questions before we throw open the floor to questions. Nilesh, I'm not asking for what your call is on that particular investment right now, but one of the one of the investments that I know of yours which has done extremely well is a new age company, or at least was a new age company a year and a half, 2 years ago, Persistent Systems. Why? I'm just taking this example to ask you, why is it that you chose that company when it was in its nascent stage? What convinced you that, hey, this is a great investment to look at?
Yeah, okay. So I think,
just the approach
that
you took.
I think this is a company on which we spend a lot of time trying to understand what this company stands for, and technology is not a very necessarily easy business to understand. And I think in that context, we had to spend some time trying to understand what this company is all about, what the management was all about. And I think this company went public sometime in 2008, 2009. And at that point of time, I think they were very early on to take this whole call that the future of technology is going to be driven by SMAC, what is now called SMAC, which is social mobility analytics, and all these emerging fields right now. And we saw that year on year, they kept executing on this space. So it was not that suddenly they said this is a fad, so they talked about it and then they stepped back. So first of all that. Two was, I think this is a company which was partnering with a lot of leading technology companies globally in terms of trying to develop new products, new technology. So to that extent, it was at a huge advantage in terms of how things are unfolding. So clearly we saw that here was a company which was executing well, and two is that it was really dealing with some of the really big boys in technology. And if the likes of Microsoft, Intel, IBM are dealing with Persistent, then obviously there are internal capabilities. But I think another important factor clearly here was the management quality. Clearly Persistent management came out as a very differentiated management.
I think we were talking about it before. Maybe the Torrent group was something. Why did you take that call when you did it?
Well, I mean, we've had luckily a few good picks in the last couple of years. One was this Torrent Pharma. I like the space, pharmaceuticals, and worldwide, as you know, healthcare is an industry which is growing. Everyone, as the increase in income, spend more on health and so on. So it was in the right space, right management. What Nilesh was talking about, vices and so on. They have that characteristic, very obvious. It's a decent group that way. And then you looked at their risk dissipation strategies. So for instance, they have a strong base in India, reasonably strong. Now it's about perhaps 50% of their turnover is from India and 50% outside India, including United States. And United States, as you know, in the branded generics business, which is what they are in, United States is the holy grail. So they had an inroad there. They were selling there. They had US FDA approved plants. They were able to make breakthroughs. Then they had gone into Brazil, an emerging market. And at that stage, there was some problem in Brazil. They had price control in some drugs, and so their profitability was affected. So it was significant in their bottom line. So when you see these kinds of things, that there are specific reasons for their performance being affected, and the market has taken it badly, that's the time you get in and you pick it up. And in the last 2.5 years, it's multiplied money 2.5 times. So it's not a bad story. And it is based on, first and foremost, both Ratnesh and Nilesh said, management, and then the industry, and then of course the company.
Great, this was fantastic insight. Thank you so much for that. What we do is now take a quick break. We come back and ask the students to grill these three gentlemen out here on how they would recommend investing. Back with Back to School, and now literally taking it back to school, handing it over to the students of Jamnalal Bajaj to ask their questions to our panelists. Please raise your hand, announce your name, and then you may ask the question to any of these three panelists.
Good evening, sir. My name is Mrudul Parekh. So I had a question, as in we recently had SEBI banning a big company from entering into stock market. So as a shareholder, how should we deal with that situation, since we were not aware, as in initially when we had invested, we were not aware about this situation. So how should we go about it?
Nilesh, you want to take that?
Yeah, I think, I'd probably say that this is more like, for an investor, it could be a potential black swan event, where it's kind of a unknown. If you are basically a investor and who's really gone by the name and things of that kind. But I kind of just touch upon 2 or 3 things here that, you'd probably think of this company as the biggest in its sector, the number 1 player and all that. So size need not necessarily be a good enough condition to kind of make an investment. So don't just go by the fact that you want to invest only in the number 1 or the number 2 players. Okay, number 1. Number 2 is that I think if you had looked at the balance sheet of this company, okay, I think there's a very high chance that you would not want to invest in it. Okay, so I think the balance sheet itself, and I was referring to earlier that most people kind of look at the income statement, but do not really go down to the balance sheet, and more importantly, do not go down to the cash flow statement. Okay, but if somebody had paid attention to the balance sheet and the cash flow statement, there's a very high probability that you would have not invested in this company. Third is that I think the company you're referring to went public a few years back. Okay, I think the most important document is basically the DRHP. The DRHP really tells you a lot more than what even 1 year or 2 years or 3 years annual reports will tell you. Okay, so I think if you had looked at the DRHP, a lot of these negatives because of which this company was perhaps given the kind of treatment or whatever judgment was passed, I think the DRHP itself would have given you a lot of indication. The fourth is that these are rated companies, okay? So I think there are rating agencies which are doing a fantastic job. So of course, CRISIL, Pradip was the founder CEO of CRISIL. I think that's doing a fantastic job. There are other rating agencies who are doing a fantastic job. These are companies which have borrowed money from banks, okay? Their instruments are rated. Check out the ratings of these companies. So I think when you look at a combination of all of these things, the balance sheet, cash flow statement, rating reports, DRHPs, I think all of these things, I think if you looked at all of these things, there's a very high chance, a high probability that you would have not invested in this. But if you've overlooked all of these kind of things, then you will have to pay a price in this market. I mean, this is what you call as risk. A lot of people talk of risk as, you know, currency risk, sovereign risk, political risk, social risk. I mean, you have dozens of kind of risks which talk. But according to me, the biggest risk which an investor faces is not doing his homework well. I think the day you do your homework well, you would essentially take care of a lot of risk. Okay, the day you don't do your homework, it means you've not taken care of risk. So I think you have one eye on return, but you have your other eye on risk. So some of the risks are things you cannot do with. I mean, there will be some risks along the way, but I think a lot of individual company specific risks, I think you can do away with by doing your homework well.
Yeah, so my question is addressed to all the panelists, but especially to Pradip sir. So good evening, sir. Welcome to JBIMS. My question is that when you say that your portfolio consists of stocks like IT and pharma, so and you also look at only the bottom-up approach and not the macros. So what do you think when the imminent decisions like Fed rate hike comes into the picture in the next year, coming year, June 2015? So what will be your strategies around these events? Because you don't look at the macro event, and mostly pharma and IT are generally generating most of the revenues from US markets. So what will be your strategy?
I don't think he said that, but still you don't respond to that?
Yes, I don't think you can ignore macro events. That's not the message that I conveyed. But if US rates do get hiked, and it'll take some time before they get hiked, and they'll start feeding into the market, and then at some stage people will say suddenly the ratio of interest-bearing and non-interest-bearing securities is, has to change, and that's when you will see correction. And you started seeing a little bit of correction in the commodities market, partly because of slowdown, but partly also because of anticipation of interest rates going up. So you will see that. Having said that, there is, and I think going back to what Ratnesh said earlier, there is an opportunity to make money whether it's a down market, up market, if you do your stock picking right. The market tends to go towards a fair value, but there is always an aberration, and if your research and if your judgment suggests that there is an aberration, there's an opportunity to make money. In India, we don't do short selling as much. I mean, I'm personally not a great fan of short selling, but I certainly think that there's an opportunity to go long in a growth economy, when you are growing at 4, 5, 6% and maybe at 9% at one time and going back perhaps to 8, 9%, being long on stocks can be a great opportunity. So you can take that longer term perspective. So you will be able to do research on the sector of your choice, not necessarily just IT and pharma. It could be some other sectors which, if US interest rates rise, will benefit from in the Indian economy, and you can make money out of that. Okay, there will always be, with the 4,000, 5,000 companies listed in the market, there's an opportunity to make money in the Indian market.
Okay. Gentlemen, thank you so much for joining in today on this leg of Back to School and giving some sound advice with regards to the current market scenario as well, but even generally to the basic tenets of investing. Thanks so much for being on the show. Thanks so much, students, for being in this auditorium as well and giving us a chance to do the show in your B school. That's it on this edition of Back to School, the Diwali special. Thanks so much for watching.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.